Hi everyone, I'm Zev Fema, Research Analyst for Action Alerts Plus, and welcome to TheStreet's Weekly Roundtable, where we'll discuss the major news stories from the week, their implications on the market, and of course your portfolio, and what you need to know for the week ahead. This week, we'll be discussing the attack on Saudi Arabia's oil facilities and what that could mean for the oil and defense industries, WeWork abandoning their IPO plans and what investors are looking for when a company goes public. We'll then dive into the Federal Reserve's decision to cut interest rates, the housing market, what it means for the U.S. economy, and your portfolio. We'll also dive into entertainment, taking another look at the streaming wars, cord-cutting dynamic, and if you know me, you know I love gaming, so we'll be taking a quick look at the gaming industry. Finally, we will of course be talking some of the names that reported earnings this week. Joining me today to discuss this are Tony Owusu, breaking news reporter for TheStreet, Bob Lang, co-manager of the Trifecta portfolio, a real money contributor and founder of ExplosiveOptions.net, and Jeff Marks, senior portfolio analyst for Action Alerts Plus. For those unfamiliar with Action Alerts Plus, it's Jim Cramer's charitable trust portfolio that Jeff and I run along with, of course, Jim Cramer. It's our way of helping to educate those looking to learn the ins and outs of investing via real-time alerts, trade ideas, and educational tools such as a monthly members-only call with Jim, where he breaks down his latest views of the market and what he believes investors need to know for the time ahead. Our goal is quite simply to make you a better manager of your own portfolio. All right, guys, let's dive in. Coming into the week, the big story was the attack on Saudi Arabia's oil facility. It sent the oil futures soaring on Monday, but they came back down after Saudi Arabia reported that they would have operations back online very quickly. Tony, you are, of course, breaking news reporter for TheStreet. Obviously, you were covering this. What are the implications for the oil industry?
Well, I think the price change from jumping on Monday to falling back down on Tuesday, I think that's the biggest story because it shows the Middle East isn't as important when it comes to energy production as it used to be. The U.S. is the largest energy producer in the world now, which a lot of people don't know, but the largest energy producer in the world now.
Permian, right?
Yeah, Permian, like in a lot of natural gas, that we have a lot of oil here. So the volatile nature of the Middle East isn't as important to oil prices as it used to be. Obviously, they're still collectively the largest, but now the U.S. is the single largest. So, and then Saudi Arabia got its oil back together. They got the affected refineries cut the production in half, but they got it back so soon, so that helped prop up energy prices. So
right, and we know their energy minister is saying that they're going to have, I think, pretty much everything online by the end of September.
Right.
So Jeff, let me ask you, we did a little bit of selling earlier this week. What are your thoughts on it?
Yeah, I would agree with what Tony just said. You know, there was a lot of talk Monday, is this going to be the rebuild of the equity, of the risk premium back into the commodity? Energy had a nice run in the week prior, and this move in the rotation back into some of these names. But I think what we saw this week is a lot of these stocks couldn't sustain a rally, and that's kind of what we were thinking on Monday. So we used the strength Monday. We trimmed. We've been in the house of pain in Schlumberger and BP for multiple years now, but we used that strength to lighten up on both those positions. And as you can see through the rest of this week, these stocks all gave up their gains.
Right.
I think there's just a hesitation to own these right now. The contrarian in me wants me to think, hey, they have really good dividends. Maybe that's just sit put. But I don't know what it's going to take to get oil higher again.
Right, and to Tony's point, I mean, we produce so much here in the U.S. that the commodity itself couldn't even hold over 60. I don't even think into Monday morning.
Right.
Bob, let me kick this one over to you real quick. So, switching it up from oil specifically, the reports are we're pretty sure that Iran, or at least the Houthi rebels in Yemen, who are backed by Iran, that they're behind this attack. But my question to you is, tensions are obviously high in the Middle East. I don't see that changing anytime soon. What does this mean for the defense stocks, your Northrop Grummans, your Lockheed Martins, your Raytheons?
Yeah, that's a group that I've had my eye on for quite a while. And actually, there was a recent merger that took place between L3 and Harris. That company also needs to be explored as well. But I think that as long as tensions remain high and the visibility of the potential for an attack, either from us or from the allies onto Iran or any of these other countries, in Syria perhaps, these companies are going to be upfront because they have the weaponry and they have the ability to sell a lot more product out to the government and some of these other governments abroad. So It's no surprise that over the past 2.5 months, as tensions have been rising, especially with Iran, that these stocks have remained quite bid. In fact, Northrop Grumman came out with earnings last time around, and they got smacked, and then bounced right off of the 50-day moving average and right up to near all-time highs again. So these companies definitely need to be paid attention to. But I do also want to mention something to you, Zeb, about the oil. We can't forget about that terror premium. I think Jeff mentioned it as well too. That terror premium is going to be a part of the crude price, not just WTI, but also Brent crude for quite a while now. We had that a few years ago. It kind of dissipated a little bit as supplies of the United States started to increase and exports started to increase as well too. But that terror premium is right back in there again, and I can't see oil, even if more supplies come online, getting back under $50 anytime soon.
Okay, so real quick, anyone have any other thoughts on the defense side of it, Tony?
Well, yeah, absolutely. I think it's interesting that President Fire and Fury, President Trump, he's been very dovish when it comes to Iran specifically, but just war in general. You would think that after all the rhetoric that he's said in the past, that he would have been more hawkish on going to war with Iran, but he's increased sanctions, but he hasn't moved the needle in terms of that. So I think that's something to look at too. Like the disruption of the oil market probably won't happen if the U.S. doesn't step in and do something with Saudi Arabia. And I think President Trump's dovishness on war, I think, is an interesting thing to watch.
On top of that, Bolton's out.
Bolton's out, yeah, right. He was one, yeah.
Yeah, and I would only add radar and deterrence. Those are probably the defense companies you'd want to look at, specifically those who specialize in that, as the way to play the news.
So radars, would that be like a Raytheon? We used to be in
there.
Raytheon.
I think Raytheon's perfect. Yeah.
Okay.
Merging with UTX.
Right, absolutely. That is one we've been keeping our eye on for sure. So let's switch it up real quick. And Bob, I'll throw this one over to you. But the other big news this week was that WeWork canceled their IPO. So my question is, what happened to WeWork? And then more generally, what are investors looking for when a company goes public?
Well, I'm old enough to remember when during the .com days, the one stock that everybody pointed to blowing up all the IPOs was Pets.com. And I think today's version of Pets.com is WeWork. There's a lot of companies out there that have come public over the past 6-7 months. Actually, probably a little bit longer than that. And there's quite a few more that are trying to come on out there because the money's flowing. That's what they want to get their hands on. I think this WeWork, I took a look at one of the proxies for this company, and they said they actually have some accounting issues that they don't even think are going to ever be resolved. So, if you look at that, you look inside the underneath the hood here, there's a lot of problems over here. But, if money's still flowing after these things, these companies are going to want to come out. It's a matter of musical chairs here. When the music stops, you better have a seat to sit down in. I think that this is more troublesome than anything. But the market is smart enough today, smarter than it was perhaps than it was 20 years ago when the whole .com bubble imploded. And maybe they're after earnings and they're just going to shun this one altogether.
So does anyone else want to take that? Just thoughts on the IPO space in general?
Just going through a couple of names that have IPO'd recently: Slack, Uber, Lyft, Slack, Uber, Lyft, Snap. All of them are down big after their IPOs. Like Bob was saying, once you look under the hood and there's either no profitability, no path to profitability, investors aren't as trusting as they used to be. Silicon Valley needs to get that together. These apps that are coming, think they can make a quick buck on the public markets, may need to rethink their strategy.
And I would also add it, just back to WeWork real quick. The other thing is, in addition to a path to profitability, we're always looking for different signals. I mean, WeWork, we had a debt raise before the IPO. We had the CEO was jumping out, selling off shit with something like $700 million getting out. He was actually leasing back to the company. So tons of conflict there, corporate governance. Yeah. Anything to add on that?
So governance is going to be a big question here. And so for me, what I'm looking at this is a little bit too cavalier for me. Really uncertain path to profitability, you're going to have issues with governance. So how I'm kind of looking at if they do end up IPOing is that why not, let's see how they perform as a public company. Let's see what they do under that when you get that additional spotlight. It's very different when you're private versus public. So why not wait a little bit? If they are able to figure it out, there's going to be gains here for years to come, potentially. So why not just wait, maybe not bite right away, and let's just see what happens when they are, forced to disclose as much as a public company.
Is that not putting the cart before the horse, though? Shouldn't you get that in order before you go public, as opposed to waiting until after you go public to get all of that together?
Well, I mean, look, maybe you won't get the best price, but you're not going to battle it in the beginning. And, maybe you just don't want to, I mean, you reference all these IPOs that are struggling right now. How many of these do you want to battle?
I mean, I think that's a great point. Because the one thing
about the Boston Fed president, Eric Rosengren, came out this morning. It's odd that you see this sort of thing happening, but he talked about troubles possibly down the road of commercial real estate, and he isolated the type of business that WeWork is doing as could possibly very troublesome to the real estate markets out there and the leasing of these buildings. So it's not often that you see a Fed governor really targeting and isolating one little area. That he was very vocal about it this morning and very displeased about about the trends in this particular area.
Right, and the one thing I just would add quickly is to Jeff's point, as far as like chasing these IPOs. I mean, for every Beyond Meat that there is out there, where it's like you had to be the first trade to get it going. Again, there are the Ubers and the Lyfts. So, I mean, I think that's a great point. Like, let it come into the market. Let's see what the public markets are thinking. I think Warren Buffett's even said that, for the most part, he has not bought IPOs in a long time, but for the most part, he doesn't jump in right away. So I think that is
it's for the longer term view investor. Right. I mean, if someone's trying to make a quick buck, maybe they'll see an opportunity there, but that's a little bit harder to figure out at first. Yeah,
absolutely. Let me just ask real quick, because we are on IPOs. Does anyone have any thoughts on the Peloton IPO?
Just watch out. If you've been paying attention, just watch out. The business model seems, I don't know. I would have to see more from it, honestly. Like, I don't know if the business model is that sustainable. I don't know if there's a path to profitability, honestly.
So to that, what I would say is I like their business model, kind of where they sell you the hardware and then they sell you the services. It's kind of like what Apple's trying to do, but we've seen how difficult it's been for Apple to convince people that they can sell service. I mean, we're talking Apple here. It's not exactly Peloton. They have cash to burn and stuff. And then Peloton, you have, I think, just 20% of sales were the services. So definitely, again, to Jeff's point, and don't rush in on this one.
Athletic and wellness trends, they tend to be a little bit fatty too.
Right.
So who knows what type of longer term business model Peloton has out there.
I think
it's tough. I mean, everyone who uses the product, I hear it's
fantastic. It's an amazing product. But
my brother has one. He got the hardware on a 0% loan, which is, I mean, you can't argue with that. And and then he has the subscription to it too. But again, these things tend to end up being a little bit of a fad. Who knows?
Oh no, from a consumer standpoint, the product's not bad. I think it's like $60 you get the bike, another $40 for the service, so it's $100 a month, comparable to a gym membership. You'd argue at some of the more expensive places.
One thing also on the Peloton, I noted, I read in their proxy statement, they also said that there's some litigation that they have
with the music.
So I'm not sure how stringent that's going to make things for them, but that also is another reason why I probably would shy away from it.
Yeah, no, definitely something to watch. I mean, for me, the gym music is key. Bad playlist, Absolutely. Bad workout, pretty much. All right, Evan, let's switch it up a little bit, go a little bit more macro. So this week we got a Federal Reserve rate cut. Jeff, he cut 25 basis points. Was it the right decision, and did he cut enough?
Yeah, I thought it was the right decision for now. I mean, look, there's obviously the conversation can be had. Maybe you just do 50 basis point and rip the Band-Aid off. But I think overall, I thought Powell handled himself well, and you saw the market respond to that too. Initially, you had sort of that shoot first, ask questions later attitude. It sold off on the immediate announcement. People called it a hawkish cut for what it's worth. But as he spoke, he talked a little bit. He got a little bit more granular. How they have their eyes on the ball. They're looking at everything, and they'll respond appropriately. And I thought the market responded accordingly to that. And you saw we actually, the Dow finished green on the day.
Right. Maybe people started to realize, don't fight the Fed is.
Yeah, and it still
holds, right?
It's interesting too because you cut, yet you still saw Treasury yields, like the 10-year longer dated yields, actually rally from their low from the day, which is generally a sign of economic growth in the future. So you're having the short range kind of lowered, yet the longer range is the yields are going higher because people think economic activity is going to pick up.
Uptick in inflation, demands a higher interest rate if they're going to put it away for 10 years, things like that. Yeah, Bob.
The bond market doesn't like the Fed tiptoeing around. They don't want it. They wanted a little bit more of an aggressive move. If not the cut being from say 25 to 50, but they wanted a little bit more bold language and they didn't get it. This is why interest rates have actually come down quite a bit. We're down to 10 years down to 170. We're a little bit below the Fed funds rate now. The curve is flat now. It's not inverted any longer for now. But it wouldn't take much to get rates pushed down one more time, and the bond market forcing the Fed's hand one more time in October. I don't think the data, though, is presenting a good argument for them to cut any further, though, however.
So, I mean, if anyone wants to jump on this, safe to say that China is still the key overhang on the market. The Fed's kind of maybe not doing what Trump wants, but they're giving us the room to kind of keep the economic expansion alive.
Well, to kind of go off of what Bob was saying, like you would think this type of stimulus would come with a faltering economy, but from most indications that this isn't a faltering economy yet. So I think that we're getting mixed signals from the Fed, and it's confusing in a lot of ways. Obviously, Jerome Powell has pressure coming from the White House, but like I don't know, it's usually they haven't gone to QE yet, but like this is a move that you would think that would come with the faltering economy.
Right, but could you argue maybe that international yields being where they are kind of forcing the Fed to come down a little bit, just so we still have that wide differential, but maybe we don't want to.
Donald Trump would certainly point to that. Yeah, absolutely.
Yeah, he'll absolutely point to it.
Yeah.
I think one of the keys is that when the Fed cut the rate yesterday, that the dollar went up. So you would think that with lower interest rates, the dollar would probably get a lot weaker. This is what I was telling you before about the bond market doesn't believe it. So when you match that, bond yields actually went down, dollar went up. That they either foresee the Fed cutting more, or that they should cut more, or that the economy is going to get weaker in the back half of the year and into early 2020.
So Bob, actually, let me stick with you because you did mention the economy, macroeconomics. Home starts, we got home starts this week, the strongest in over a decade. Building permits, the strongest since 2007. I mean, what does that tell us about the economy and the consumer? I know you guys initiated Visa this week for the trifecta portfolio. I mean, how are you taking this data and applying it to your portfolio?
Well, I would have been really shocked if we didn't see strong housing start data. With the 30-year bond was down at 2% has been for about a month and a half. I mean, mortgage rates probably 3.25. I mean, it's a boondoggle for anybody who wants to buy a new house right now, isn't it? So I think by and large, the problem that we have here, as long as the job market is strong, housing market is strong, retail is strong, you're going to get some parts of the economy that are going to show some strength, but then you're going to have other areas like manufacturing, industrial, so forth, that are weaker.
Right. PMI contracting.
PMI contracting. We've seen the ISM number was actually strong for services, but not strong in industrial. So I think these are some issues that we're going to have to get through, and there's going to be some areas of the economy that are going to be strong and others that are going to be weak.
Jeff, any thoughts on that? We own MasterCard in the portfolio. That's obviously a play on also the shifting payments environment, but the consumer as well.
Yeah, and if you look at the consumer confidence, it's a little off its 2018 highs, but it's still the highest it's been since around 2004. So, I mean, you have what am I trying to say? Wages are increasing too. You have minimum wages in 20 states have raised their minimum wage this year. So you're seeing higher spending, and then as you have the ongoing shift from cash to a credit society, even into contactless, it's just an absolute tailwind for names like MasterCard and Visa. And with MasterCard too, they were out speaking earlier recently at an investor conference. They have a huge opportunity too with the business on the business to business side as well, which is really, it's untapped. And they're doing a lot of acquisitions right now to really build that up. So it's a name we like for Action Alerts Plus. We own it. We look to buy it on nearly every pullback.
Right. I mean, we like it for Action Alerts Plus. You mentioned business to business, but I think the real trend there is also just digital, like account to account, right? Like it's this move away from plastic as we're kind of just sending from one account to the other, and they're obviously making all the acquisitions to kind of to jump on that trend. And then the other thing is also when contactless payment makes its way onto the scene, we see more spending because people just don't think about it, whether that's good or not. You'll have to decide, but that's a trend that MasterCard's jumping on, Visa's jumping on. And the other thing is in markets where you see the transportation systems that they have contactless. It incentivizes you to put that payment method on your phone, and then now that you have it on your phone, you're kind of again just more catalysts for more spending.
Hey, Zeb, I would also, if you don't mind me, to Jeff's point, I think that what's important for MasterCard and Visa to remember, look what's happening today or the last couple of days to Netflix. Okay, they had the first mover advantage, then all these other companies started coming in and invading their space. Well, this is the same thing that's sort of happening with Visa and MasterCard, right? This with Apple Pay, with Square, with Stripe, with Venmo, which is part of PayPal. These companies are coming in and taking some share from this enormous share that MasterCard, Visa, American Express, Discover have. And they're going to have to think of some ways to fight off the competition there. Otherwise, they're going to, they could suffer some terrible fate like Netflix.
Right. I mean, the other option is, of course, join them. We know MasterCard jumped in on the Apple Card with Goldman Sachs. Tony, any thoughts on the payment space?
No.
No, I know. Fair enough. I think we kind of covered all of it.
I know Bob mentioned Stripe. That was a huge valuation that it got this week.
Yeah.
I don't know if you call it that. Huge valuation there. But I think added too to the point of people like coming in, taking in share. I think PayPal's almost been a little bit of a laggard in the group recently, and that's really because it's really MasterCard and Visa have that strong duopoly in the payment space. And I always view PayPal as a terrific name. We owned it for Action Alerts Plus. We made a lot of money on it. We sold it. We exited a little bit too early, but we still made a lot of money on it. But that one still has more competitive threats from the Squares and the Apple Pay, as you mentioned.
I'd agree with that completely. And Apple Pay is a big one because I'm a big user of Venmo, but Apple has just made it so easy to whether it's contactless payments or it's transfers via text or whatever it is, it's right there. So let's switch it up real quick because we always like to say that housing punches above its weight. And what I mean by that is when you buy a house, the thing you go do next is you hook up your internet, your broadband, and your streaming services. So this week, Comcast is actually announcing the name of their streaming app, Peacock, and they also announced that they would be giving out a new streaming over-the-top box to internet-only customers for free, which sent shares of Roku down. So, Tony, where do names like this fit in the streaming space?
What are names like Roku and
Comcast, Roku, Netflix, whatever it is? Just sort of how do you see the space evolving over time?
Roku is like Bob was saying with the payment services. Roku is getting its lunch eaten with people coming in and like they were first to market, but now everybody's coming in. Same thing with Netflix. People are coming in and taking away their market share. And like we discussed last week, content will be king. Content always will be king, and it'll depend on who has the most exclusive stuff that people want to see. So HBO Max, all of these other streaming services,
AT&T service,
AT&T service, like they're going to be fighting for this premium content. And actually, Forbes had an article today that I thought was interesting, talking about how Apple should buy the rights to the NFL for its streaming services because live sporting events is huge for the NFL had the top 10 most watched programs.
Sunday Night Football.
Night Football, like last year, and that's been the way for 30 years now. So like live sporting events will be huge for the streaming services. Whoever gets on that first.
ESPN Plus, something.
And don't forget the combination of CBS Viacom is going to be a big one in here. Don't forget they have Showtime and they have all the huge, humongous CBS library that they can access, and Viacom as well too, Comedy Central and these sort of things. So I'm sure their product is going to be coming out over the next 6 to 9 months, maybe after that deal closes. And that's going to be another formidable competitor for Apple and for NBC or whoever and Netflix. So yeah, competition is really, really stiff here.
So Bob, since you did mention like the companies that have this deep library, also Netflix secured the rights to stream Seinfeld for 5 years, starting in 2021, after losing The Office to NBC. Again, they're coming out with their own service. Everyone's kind of pulling back in, and then AT&T's Warner Media division scooped up Friends. So Jeff, my question to you is buying legacy shows the right strategy for these companies to pursue, and do you think that is a trend that Viacom can take advantage of?
Yeah, I do think it is a good strategy because you already know you have a proven product, right? And I think you have a proven audience. You know people. There's an interest in these shows. So I think buying that type of brand will get or keep members on your platform. But I am getting really nervous about Netflix. And I think what we're seeing right now, in addition to just the highly competitive space, is that we're seeing a lot of ad-supported business models out there. And Netflix doesn't have one yet. But if their hand is kind of forced in doing so in the future, just to kind of compete with these cheaper offerings as their peers, they're going to lose their pricing power to raise prices in the future, because then they're going to be worried about people moving from the subscription model to the ad-supported one. And if they lose their pricing power, I mean, what is that going to do to the multiple?
I mean, I would even push back on that and say, to some extent, someone could jump in here, but I would argue they've kind of lost some pricing power. You got Disney coming out at $6.
Apple at $5.
Apple at $5. We'll see what Peacock is,
Right.
but to your point,
So
ad-supported.
they announced the price hike, I think it was at the beginning of this year, so we haven't seen one yet. But yes, they have, and they are losing their pricing power.
Right, so that's, I mean, yeah, Bob, anything to add on that?
Yeah, Zev, and to Jeff's point over there, what about the pricing is concerned? You know, HBO now came out above Netflix, and Netflix took off. This is about a year and a half ago, and they took off to the high side, and even left Netflix enough room to raise prices one more time, and then it started to fall. But I would also tell you what Jeff was mentioning about these legacy shows. As far as the Seinfeld's concerned, and listen, I've probably watched every episode 5 times each. I would compare this to your beloved Yankees bringing in a 44-year-old Mariano Rivera. He had it maybe 10, 15 years ago, but does he have it anymore now? I don't know. I mean, probably. I know, of course, he's retired, but I mean, the point is that are you bringing in a tired arm, an old arm, that to try and carry you to past glory? I don't really think that is gonna work all that much for especially for Netflix.
Right. Tony, agree? Disagree?
Well, I actually disagree. I'd push back on that. Not only is content king, but bingeability. You can put
Bingeability, definitely.
You can put on Seinfeld in the background and just let it run, and that's great for Netflix.
Half my TV viewing.
Yeah, exactly. Like I rewatch things all the time. I'm currently rewatching The Sopranos on HBO, but that's not kind of in the same vein. But something like 30 minutes, 20 minutes that you can just put on in the background while you're doing something, while you're cooking, that's going to be huge for them. So getting Seinfeld is actually, I think, a very savvy
20
move.
minutes is actually like my go-to because it's quick.
That's why The Office is so popular on it. You can just put it on in the background.
That's what I was going to add. So what were some of the most popular shows on Netflix? The Office and Friends, some of these older content shows. It's not some of the newer stuff that they're putting out. I don't know if that's a knock against the new stuff that they're putting out, but there's still such a love affair for these older type shows. Seinfeld's a little bit older. It might appeal to maybe a different generation.
I love Seinfeld. I think Anthony watches it in the mornings when he's getting out of the shower.
I think it speaks to people of all ages. However,
but it is 30 years old.
It will have exactly. So we'll have to see
we
how
still
it
exist.
fares.
30-year-olds still exist. It's not all about millennials and Gen Z. We still
No,
exist.
the show is 30 years old. Right.
And the people who watch it are usually over 30. Like we still, those people still exist. It's not like they went anywhere. So yeah.
The other thing is though, with these shows, you've got hundreds of hours of content. You know someone's watching it. You don't have to invest in all the production just to end up with a flop, which has kind of been an issue with some of these streaming platforms. The question is, and I think to everyone's point, is content is king, and is it quantity versus quality? I think Apple's really going to put that to the test because they're only coming to market with 9 shows. So I mean, we'll kind of have to see. The other thing I do think investors should keep in mind is that from what we've seen, surveys tend to point out that in the long run, the expectation is people will ultimately have 2 to 3 platforms. I think the one caveat there is there will be the question of how many screens can you watch on. For example, if your parents have, if they have a subscription, can we kind of share subscriptions? In which case, maybe you do end up with families that have 5 or 6 services. But in my mind, when I'm looking for an investment, the question I always have to ask myself is, of all the streaming platforms out there, is this top 3? So I mean, for me, and anyone can feel free to chime in real quick, but for me, I'm very curious to see what HBO comes out with. HBO Max, AT&T, what they come out with. They do have to pull it together. They have some operational issues maybe, but the content is definitely there. And then Disney Plus is the other one, and you can bundle that with Hulu and ESPN Plus for the same price as Netflix. So pricing power is going to be an issue.
Zev, to your point that there was a survey done by Mark Mahaney at RBC Capital. Said that 70 to 73% of those surveyed would have multiple services. Actually, even more than what you were saying. So the 70% people would have more. So Netflix, as you said, Peacock maybe, and Disney and CBS, whatever they come up with, so forth. So you're right.
Bob, we do have to move on, but I couldn't hear you in the lesson. What was the number of services that the survey pointed to?
3 to 5.
3 to 5. Okay.
3 to 5. Yeah,
So that's the question, right? The top 5.
If you're ad supported too, maybe you're paying a smaller price point.
Right.
That
Right,
will help
so
to that as
you
well.
can kind of sneak in there at the bottom.
Yeah.
So listen, we are running out of time. So just real quick, Jeff, any thoughts as far as like Apple Arcade? Is it just another service stream that they can pull you deeper into the ecosystem with?
Yeah, incremental. I would call it incremental.
You're not buying it because of that.
So, and me personally, I'm not a buyer of the product just yet. I want to see what type of games get onto the platform. But hey, for those type of people who are big gamers on their phones, maybe you're commuting, maybe you're just looking to pass the time. It does seem like a great value to
Especially
those.
if you have kids, $5
I was
a
about to say,
month for the
I think that's
family.
a big play for kids, getting them in the ecosystem early.
Exactly. So that's the key, right? What Apple needs to do is they need to maintain and grow their market share of the smartphone industry, and products like this will go a long way.
Right, absolutely. All right, we're running out of time, but I have to ask. I want to talk earnings real quick. We'll just stick to one today. FedEx. Tony, you covered that one. Obviously, FedEx, given their global operations, it's the shipment of goods. There's a lot of information to gather that as far as the global economy. Tony, what was your thoughts on the quarter?
My thoughts. I thought it was interesting. Deutsche Bank really eviscerated them in their note this week. They said they heard the call, and they said the CEO is not taking any responsibility for his own missteps in the company. I think that's huge. I think people are going to try to use the trade war and try to use.
There's a lot of mention of that trade.
Yeah,
of the trade war.
and companies are going to try to use that to get out of their own mistakes. And I think Deutsche Bank calling him out on it didn't help the stock. So that was my thoughts on it.
Right. Anyone else? Any thoughts on the FedEx quarter? Bob?
I think that there's they've lost a lot of business due to Amazon. I think they've lost going in a different direction, and I think that FedEx numbers are going to continue to get cut. UPS has also taken a lot of share from them, and eventually they're going to come around, but it's probably a 2021 story.
Yep, and I would only add, Bob mentioned some of the competitive dynamics. What does it say about FedEx if they aren't crushing it when e-commerce has just seen such explosive growth over the last couple of years? That's my concern.
Right, and they kind of downplayed the loss of Amazon, but I'm not really buying it. They do mention that a lot of the growth will be e-commerce.
Yeah, they said Amazon was 1.3% of revenue in 2018, but like that, I understand what you're saying though. It feels like it's been
just the
downplayed.
growth going forwards.
Right.
It might be 1% here, but the expectation, at least if you're looking at the estimates that were done a few years ago, is that Amazon would grow beyond 1%, and now you got to pull that out when you're discounting the earnings back.
Exactly.
And if you want to kind of know the whole math behind that, we have a whole earnings valuation white paper over on actionalertsplus.com. All right, guys, that about wraps it up for this week's show. Be sure to get over to TheStreet.com for all the market coverage you need, and for more in-depth advice on portfolio management, get over to actionalertsplus.com and Trifecta Stocks. Check out realmoney.com for all types of trading strategies. Finally, a big thank you to my guests, Tony, Jeff, and Bob, for joining me today. I'm Zev Fima. We'll see you next week.